Hello, this is Scott, and this is a video that I promised actually a couple of weeks ago. Then I got sick and I lost my voice for about a week and a half, so now I'm ready to do it. I do want to say that living in the Midwest is everything I ever dreamed it would be. It's absolutely wonderful. But anyway, I'm not going to blame my sickness on the Midwest, but I am. The video today is going to be on a portfolio of robots and how a portfolio can make your trading that much better. Now, this particular portfolio is based on weekly pivot robots. So these are just robots. They're very simple strategies, and you can find it in my course. If you're listening to this already inside the course, then presumably you know where to find it. But this particular strategy just waits for price to get away from the weekly pivot and bets on the likelihood that it gets down to the weekly pivot. And you can see a couple of trades recently here. This is September 2015. And you can see price is away from the weekly pivot. It closes below our entry threshold and it goes down and we take a profit. Price rose back again, went beyond our threshold, hadn't hit the weekly pivot yet. We took another trade and traded it down to the weekly pivot. It's all based on the likelihood of currency pairs to hit their weekly pivots, and they do over and over and over again, and that's what this robot tries to take advantage of. So that's what we're trading, a portfolio of these types of robots. Now let's go to the spreadsheet. Here are 6 robots of exactly this particular type. On the far left, we have a dollar-yen on a 10-minute chart that goes short only. We have a dollar-yen 10-minute chart that goes long only. Because remember, the long side of the market and the short side of the market, they're not the same. They need different parameters. So these both have different inputs. Then we have the Euro-Aussie on a 60-minute chart, which only goes short. The Euro-Aussie 60-minute that only goes long. And we've got the pound Swiss that I mentioned in the course. And we've got the pound dollar that's a 10-minute chart that only goes long. Now, what we're talking about today is what happens instead of trading just one of these, what happens when you trade them all together and what can that bring you? Well, let's get right to the numbers. I'll do the end part first and then I'll break it down and describe it a little bit more in detail. I did this research on these particular robots and I did it all the way back to 2008. I really feel like anything before 2008 is a little irrelevant. I do have research that goes back to 2003, so you can look at that if you want, but I just am finding more and more that really only since 2008 to now, it's still several years and many, many trades, I just feel like that's a little more relevant. In fact, 2008, 2009 might not even be relevant. I may even move that up. But by way of explanation, we're going back to only 2008, okay? Back to the top. Since 2008, this portfolio of 6 has returned on average $946 a month. Now, on average is the key part of that phrase. That doesn't mean you make $900, $950 every single month. It doesn't. It means on average. So you're going to make more than that. You're going to make less than that. It's easy to look at this number and say, okay, every month I can count on $946, and that's not true. However, if you're a trader, you know that losses come, and you just have to be able to make it through the up months and the down months. But on average, since 2008, it's made $946, which comes out to 4.6% average per month, which comes out to 55% a year. And that's kind of the target area that I wanted to go for with this particular strategy and this particular robot or portfolio of robots. Now, what kind of account size are we talking about? Well, we're talking about in this particular example a $20,400 account. And all that is, and the reason I got that is, I just took the trade sizes that I tested for all these robots, and I just see how much margin would that take up if I traded it. So this assumes that this particular account trades all of them at the same time. Are you ever in a trade on all of them at the same time? Almost certainly not. However, to guard against the possibility of wanting to enter a trade and not getting in because you don't have enough margin, I just made an account exactly as if all of these are trading together. And when you add up all the margin requirements for these robots, you get $20,496. We could maybe go less than that, but let's just stick to that for right now. So on a $20,496 account, that's what you average. Now, these numbers are important. I like to look at what's happened in the medium term. So since 2012, you can see the number drops a little bit. So now since 2012, this portfolio has only averaged 624, which is less. And obviously the reason is 2008, 2009 were huge trending markets and you got a lot of winners. Then I look at it from 2013 to now, and that's a little bit less. 2013 itself was just not that great. But this is a very important number to me, and it's important because this is since 2014. Since 2014, the number has ticked back up. We're still not making as much as we did early in the strategy years ago, but if we have a crisis coming, we know that we might be able to make more money because this made the most money during a crisis, so that's good. But most importantly, we want to see this trending up. I would like to see this number since 2012, since 2013, and since 2014 be on an upward trend. And it did dip in 2013, but it's making more money again. So I like that trend. I like the fact in the last year and a half we're making more money than we have at any point since 2012, and that's a big deal. That means the portfolio is something that I'm very interested in, and it's why I'm sharing it with you. And these numbers to the right here, you can see at this particular average, you make 3% a month, or that per year, 36.6. And at this particular number, you make that. So since 2014, we're at 665, and that's about 39% a year. But the power of the portfolio is this. Let's say you find a trading strategy. Let's say you like this particular weekly pivot strategy because it's simple, it's easy to set up, and you can use a robot, or you can trade it manually very easily. And let's say you like the Euro Aussie, and let's say that's the one you pick. So I'm going to trade the Euro Aussie, and I'm going to focus, and I'm never going to do anything else. If you did that, what happens if you hit this period right here? Now you can see if it's blank, it means it didn't even trade that month. So if you look around and see the blanks on the spreadsheet, that means there were no trades. So if you look at this particular period, you've got 1, 2, 3, 4 months of losing and 2 months where you didn't get any trades at all. That's half of a year on your focused strategy, the Euro Aussie. That's half of a year you get nothing. Well, wait, you don't get nothing, you get less than nothing because you've lost these 4 months. In that 6-month period, would you be able to continue and move on to the next month? Well, that's a real problem because the answer is probably not. I know I wouldn't want to. So you'd want to complain, well, the system doesn't work, or I just don't have the discipline. There are a lot of reasons to not trade this, and they're all decent reasons, right? Who wants to do this for 6 months? However, if this is just part of a portfolio, if you trust the methodology in saying that, yes, stuff goes back to the weekly pivot, and I realize it's not doing it right now, but I know it's going to in the future, and you put that particular strategy and that particular robot in the middle of 6, all of a sudden now things smooth out for you. Because in this 6-month period, for example, look at what's happening over here. The portfolio, in this particular 6-month period, you've lost $2,100. But meanwhile, the portfolio itself has made $3,800. Wow. So if you're trading a portfolio, you've made $3,800. If you're just singling out one, you've lost money. That is a huge difference, and that is the power of the portfolio. Even further, this particular cell adds up all the profits from all the totals, and this total column adds all of these up. The total number of profits in this particular column, and you can see that it adds up all of those numbers. I'll go back to the top. And that is $88,000. Not bad. That's where you get this average. However, let's say you've just picked one. Well, that one only made $12,000. The pound Swiss actually, and I've halved its trade size. So this is, I actually, in this particular study, see that 0.5? I actually cut all these numbers in half. That's why I did that, and it was easier for me to just do the multiplier. So that's actually less than that. So that's actually like 27. So that's way less, right? Euro Aussie is only 13. That's way less. Euro Aussie, way less. Dollar yen, way less, right? So if you picked any one of these, you're way, way, way less profit-wise than you are if you combined them all. And you get the added benefit of smoothing out. You get way less losing months if you trade a portfolio than you do trading just one. For example, here's a period of time on the pound dollar. 1, 2, 3, 4, 5, 6, 7 losing months. 1, 2, 3 no trade months. So that's 10 basically losing months. And in this particular, well, actually in the same time frame, you only have 1, 2, 3 losing months, and plus you've made all this money. Again, it smooths out the losing months, and it makes you a whole bunch more money. Now, it's not perfect. Nothing is. Here's a bad period, 4 straight losing months, and that'd be tough. However, there weren't a lot of trades at this period, so that might make you strong. Or you can just trust the fact that things go back to the weekly pivot, and I'm going to move on. You can see the next 1, 2, 3, 4, 5 months are big. But you're not immune. Here's another losing period with one winner in between. And there are other losing months too. However, in total, you're going to win 71% of the time on an end of month basis. This is a pretty good portfolio. The bottom line is, I love portfolio trading. It diversifies your risk, meaning less losing months, and you make a whole bunch more money. So this is a very simple system that, again, I talked about in the course. If you combine that with 5 of its friends and do 6 total, you can make a decent amount of average per month. And once again, let me remind, the trend is up. Since 2014, it's actually making a bit more money. So that's the power of the portfolio, and that's the presentation for this week. Any questions, you can always just send me an email, and I will talk to you soon.